Traders are worried an oil glut is looming in 2026, but how large will it be? The IEA says the world will produce 3.84 million more barrels of oil every day than it uses next year. That forecast comes after OPEC Plus boosted its output in 2025. The oil producers group has paused those increases for now, but it has a more bullish forecast, saying supply and demand will be roughly in sync over the next year. So who's right? Naveen Das is a senior analyst at Kepler. Naveen, what do you make of these forecasts?
Good morning. As I said, wildly different forecasts. At Kepler, we land somewhere in between. We're seeing a surplus for the oil market in next year of about 1.8 million barrels a day. And what's important to note there is we have, throughout the previous months, revised this tighter, a bit lower. More recently, we were at 2.3 million barrels per day. And I think there's two, obviously, levers that go into this surplus. We do see incrementally improving demand next year, higher throughput into refineries, but at the same token, potentially supply, if we do see prices come lower, wobbling slightly in potentially non-OPEC plus suppliers, and especially as we progress through the year, natural field declines in certain basins would take shape, potentially crimping the supply from certain producers.
OPEC Plus has increased output this year, but is now reining it in amid these worries of a glut. Will it keep focusing on defending market share in the new year, do you think, or switch back to defending prices?
I think it will continue to defend market share. It's a strategy that's worked relatively well for the group in 2025. And I think not only looking at the short term, potentially looking at the medium term horizon, there's definitely a strategy at play. What we've seen is as the group incrementally has brought barrels back onto the market, and we also do believe at Kepler that after the first quarter pause, they will potentially continue their unwind. The closer we get to bringing these barrels back, the more apparent and transparent it becomes for the market that the spare capacity that OPEC Plus holds is dwindling. Now, this lowering of spare capacity in effect will add a sort of price floor to the market, because it shows that the OPEC Plus group is potentially less able to weather any supply or demand shocks that the market may experience. So psychologically, unwinding these cuts and reducing the spare capacity is a tactic that we believe that OPEC Plus will pursue, and one that should, in the medium term, support prices.
In that case, then, do you not believe this supply glut that's predicted will weigh on prices all that much?
I think there's two effects to this. Obviously, bringing the supply back onto the market has a dampening effect on price. Where these barrels are pointed is key. If we do see a big uptick again of Chinese buying for stockpiles, this will absorb a big portion of that. So whilst we do have a dampening effect of these additional barrels, the potential of reducing the spare capacity and the fear that surrounds that in terms of supply shocks will act as a sort of a dampening mechanism. So we do see a sort of maybe a top to the market and a bottom in a relatively narrow range for 2026 as a result of these two competing factors.
This year, we've seen that all the sanctions placed on Russia have had limited impact on its ability to supply oil and therefore on the price. Could that be a wild card in 2026? Could the conflict hit impact?
It's one that's always up for debate. I think it's a factor the market has been looking at, very, very closely for a number of years now. We do think that Russian crude will continue to evade sanctions. Enforcement won't be that tight. And there are always intermediaries springing up to ensure that the logistics, the insurance, the capital funding of the Russian oil trade continues. So we think that Russian crude oil grades, physical crude oil grades, will continue to discount lower to entice buying, notably from buyers in India and China. And that this will continue as is. President Trump, I think, also wants, in a wider sense, to not necessarily pressure India and China too much, especially with one eye on the midterms and wanting to keep gasoline prices low as well. So avoiding a major disruption of Russian crude oil flows, I think, is in most people's interests. And we do think that the sanctions will continue to be skirted around and that Russian crude oil will continue to flow next year.
What about output from the US? It's kept growing this year, even though prices are lower. But is it profitable for US producers to keep drilling at this level?
As it stands, US producers continue to surprise the market, continue to find technological innovations, not only in the physical rigs, but in their use of electrification and AI to bring their break-evens lower. At current prices, it does seem profitable for US producers to keep extracting oil. One key thing to mention is throughout the price spikes in 2025, US oil producers have been able to hedge some of their future output, effectively bringing their break-evens even lower. So what that does is that puts them in a better and a healthier position to produce in 2026 and potentially weather some of the downward price we may see with in the short term, the oil glut putting pressure on the market.
That was Naveen Das of Kepler. Don't forget you can watch more videos on Reuters.com.